Sorry. Good morning, everybody.
Good morning.
I am calling the special meeting of Credit and Risk Management Committee and Board of Investments, depending on how many people here, to order. Let's see. Do I have first thing on the agenda is to approve the minutes?
Yes, I will actually go ahead and call on the trustees to confirm attendance, if that's okay. Thank you, Ms. Greenwood. This meeting is being conducted as a virtual meeting, so we'll do a roll call of the trustees to confirm attendance. Ms. Greenwood?
I am here, yes.
Thank you. Mr. Kelly?
Yes, good morning.
Thank you. Mr. Jones?
Aye.
Thank you. Mrs. Jones? Okay. Mr. Kehoe? Mr. Green? Ms. Sanchez? Mr. Santos? Okay, the staff participating in the meeting include the following: CIO John Grable, CEO Santos Cramen, Chief Counsel Stephen Rice, and Vache Mesarajian. Consultants will be Makita Investment Group and the Alborn team. Trustees, please use the Zoom chat option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak. And now we may proceed with the agenda.
Okay. Approval of the minutes. Do I have a motion?
I will move approval.
Second.
Thank you.
Any amendments or questions? Okay. Yes, Linda.
Okay. Ms. Greenwood,
Aye.
Mr. Kelly,
Yes.
Mr. Jones.
Aye.
Ms. Jones is, I think, running late. I'm not sure if she just logged in. And Mr. Kehoe, I don't think logged in. So the motion passes unanimously.
Great. Next on the agenda is public comment.
We have not received a request from anyone to address the board.
Lovely. Then item 4, the reports. So A is credit performance report.
Good morning, Madam Chair, committee members, and trustees.
Good morning.
Good morning. Two of LACERA's investment consultants, Makita and Alborn, are here to conduct a performance review of the credit functional asset category. Makita, LACERA's general investment consultant, will lead off with an overview of the performance of the overall category, and they will also cover the performance of the liquid portion of credit. Next, Alborn will address performance of the illiquid credit category. Representing Makita is Tim Filla, and representing Alborn is James Walsh. So without further delay, I'll turn it over to Tim to get us started.
Lovely.
There we go. Thank you very much. And thank you to whoever on the LACERA side is also driving these slides for us today. Just to start off on the overall credit category, wanted to highlight a couple of things. The first part that we're going to do in this presentation is an overview of market conditions and a little bit of a forward-looking outlook. There's a mismatch in timing on this because we wanted to provide more up-to-date market statistics, but the performance report that you're going to be looking at is through 3/31, and the market data that we're going to be discussing is through June 30th. So just keep that in mind as we go through the deck. And then for this overall category, I thought it would be helpful to remind everyone the role of credit is to provide moderate income to the overall portfolio, and then also some diversification benefits. In the last strategic asset allocation review, the overall credit category went from a 12% weight within the portfolio down to a 1% weight. But then due to some of the concerns that we shared with you regarding the low interest rate environment and some of the risks within liquid credit categories, the board approved a fairly large shift in the underlying categories. So the liquid category went from a 9% weight within the portfolio down to 4%. and the illiquid category went from 3% to 7%. So I think you'll see some of the benefit coming through from some of those strategic asset allocation moves that were really approved last year that laid the groundwork for some of this performance that we're going to see. So if we could advance to the next slide. Here we can see really a tale of two totally different market environments. On the left is 2021, a market environment that was still in strong rebound mode from COVID and really strong results across essentially all major asset categories, except for some weakness in emerging markets. In the 2021 year, the weakness in emerging markets was primarily driven by the continuation of lockdowns in China, and that being a fairly large weight in those markets, along with some regulatory changes and some weakness in their property markets. When you flip the script to the right-hand side, 2022 through June, the only thing that worked really here was the Bloomberg Commodity Index. The primary driver across all asset categories was concerns over inflation, and then the resulting rise in interest rates that was driven by central bank action and then anticipation of further central bank action. So really very little diversification benefit across most of the other major asset categories was kind of the dominant theme for the early part of this year. But you will see later in other performance reports some differentiation, especially in the liquid and the hedge fund categories that we're going to talk about later in the other presentation. Moving on to the next slide. I'm going to focus on the 1 year number here. So some of this isn't going to show up in the overall performance report because the mismatch in timing, this is through June 30th. So there was some continued weakness in fixed income assets and credit assets generally. I guess I should also say we're going to be using the same market deck for both of the presentations. So I'm probably just going to go pretty quickly through it on the next one. But the 1 year period, this represents the worst start to fixed income that markets have ever experienced over 6 months. So Bloomberg aggregate down 10%. Primarily, that's just all interest rate exposure. High yield, you saw some spread widening in addition to the interest rate exposure. And then emerging markets continued to be weak. That sort of script changed a little bit based on the strength of the US dollar on rising interest rates, which generally is bad for a lot of these emerging market economies. But then they're much more sensitive to certain pieces of inflation. So food price inflation, energy price inflation, all of those are higher percentages of household budgets in emerging market economies. So heightened concerns really in those areas due to some of the global macro conditions that emerged in the beginning of the year. Moving on to the next one. This is the US yield curve as of 6/30/22 and the pink line at the top. So you can see over the course of the last year, interest rates broadly have moved up quite a bit, but the curve has flattened as well. So, and if you follow that all the way through to the end of July, the yield curve is pretty decently inverted when you look at it on the 2s 10 years. We were at 30 basis points inverted. That's usually a fairly strong indicator of a coming recession. And there's certainly been lots of debate about not just how probable that is, but the depth of it. And we'll go into some of the macro conditions that may impact a potential US recession a little bit further along. So this is definitely, when you're looking at credit assets that are somewhat interest rate sensitive, really important to understand the shape of the curve and what's driving these markets. Going forward onto the next slide. Here you can see this is a little bit more updated one. So this is the end of July, so you can see that inversion. And basically of the last recessions, I think there's an 85% prediction rate on inversion leading to some type of recession in the US. Next slide. Here you can see credit spreads, and this is largely one of the main drivers for performance within at least the liquid categories, but it certainly does impact pricing within the private markets as well. You can see that US high yield did pop up above averages here recently on growing concerns for recession. So on one hand, that impacts short-term performance, but it does set the category up for more attractive forward-looking returns when you can earn that additional spread margin over time. Next slide. And then just sort of what's driving this from a fundamental perspective. Corporate financials overall look pretty decent. Capital markets, as you can see through equity issuance and corporate debt, have definitely slowed down. There's much less interest in issuing equity as markets have gone down, and corporate debt issuance has done the same as interest rates have come up. It's overall increased the cost of borrowing somewhat, and I think a lot of corporations are in fairly healthy financial positions. As you can see in the bottom, leverage ratios are at really, really low levels, and on the bottom right-hand side, you can see S&P 500 profit margins are also at fairly high levels. So ultimately, this backdrop of widening spreads and higher interest rates comes in a time when corporate profitability and overall health is rather quite strong. If we go to the next page, so you can also see just some overall indicators of financial stress that are in the markets on the upper left-hand side. Elevated, but we haven't certainly gotten to any type of panic levels. The global surprise index on the right-hand side has declined into negative territory, which means economic data is coming in below where most economists have forecasted to be. Clearly nothing like we saw back in 2020, but some cause for concern and some indication that things are slowing. The bottom left-hand corner is liquidity risk. This is something to keep an eye on, as the Federal Reserve is not just raising interest rates, but also shrinking the size of its balance sheet. So one of the sort of tail risks when you're investing in these categories that you always want to be aware of is there anything in the plumbing, and can liquidity be one of the things that starts a further downdraft? Right now, that doesn't seem to be the case, but certainly something we're keeping our eyes on. And then the bottom right is just the US surprise index. So reflects exactly what you see in the one up above, where conditions have softened and economic data is trending a little bit lower than originally planned for the year. Next slide. Here's one area that I think is particularly interesting. So coming out of COVID with all the stimulus that was in the markets, both really fiscal and monetary, consumer spending was really, really strong and a super driver of economic growth during that period. So consumer sentiment is one thing to look at, and this has been on a decline recently. So certainly something to look for if there's going to be a change in consumer behavior, and a hopeful change in spending patterns won't emerge here, but it's definitely something to keep our eyes on. And then the other one is New York Fed household spending growth. There you can see that story coming out of that sort of March-May period, where that was quite low. Really sharp rebound in household spending coming out of the depths of the COVID downturn there. Next slide. Perfect. Now, so we'll get into the overall review of the credit categories. Unless anyone has any questions on market review and outlook, maybe that's a good time to pause and see if anyone wants to engage on a topic there.
I don't see anybody in the queue. Does anybody have any questions or any comments at this point?
Oh, wait, how do I?
All right. There we go. I see Trustee Jones has her hand up.
Yes. Trustee Jones.
Good morning. I have a question just to get your insight on it. Looking at the graph of the New York Fed household spending growth, I've heard that a lot of this growth is a result of, people not spending during COVID, not going anywhere, not traveling. And, at some point with inflation going up as high as it is, that there's this theory that it's going to slow down. We had a lot of money saved up because people, just didn't go anywhere. But now that people are traveling more and there is more spending, what are your thoughts on whether this pattern is going to shift and start going downward in the future?
Yeah, those are fantastic points, and I think you really saw it. The first thing that went was goods, spending on goods, and not so much services, because people were at home and ordering on Amazon, and hey, I need a better TV, and I need new speakers for my laptop set up at home, and all those types of things. So you really saw the inflation hit the goods sector. There was clearly some pent up demand in that particular space. I think you're now seeing the shift from that goods to services. That's clearly where a lot of the pressures are in the labor markets as well, and that's going to be somewhat persistent. But the question is, how high does that demand remain? It's going to soften, as you indicated. I don't think it's going to crater, though. I think that's the key issue, right? So can we have some moderation, and that will have the dual impact of both helping to reduce a little bit of the inflationary pressures. So that should ultimately be good. We're not at a level of interest rates where I think there's a lot of demand destruction on the consumer side. You've certainly seen corporations take some slightly different actions. The housing market is clearly being impacted by higher mortgage rates at this point in time, but consumer behavior really hasn't changed other than the shift from sort of goods to services. And that will likely slow just because of that pent up demand issue. But I think it's going to revert to something that's normal as opposed to something that's really kind of negative or back to like really slow.
Understood. Thank you.
Pardon me. Anybody else? Okay, Tim, please continue.
All right, and now on to the meat and potatoes. If we could skip to the next slide. I kind of covered a lot of this, but just wanted to again highlight that a lot of this was set in motion over a year ago when we were going through the strategic asset allocation process, and the board ultimately approved a new policy that generally lowered the weight modestly to credit, but really made a pretty important shift from the liquid to the illiquid categories. And the real benefit there comes from all of the liquid categories are mark to market. They generally tend to have a little bit more interest rate sensitivity, and in the case of EM debt, a lot more dollar sensitivity. The illiquid categories can be generally characterized as sort of longer term investments that have less of a mark to market component, certainly, but also are typically held to duration at locked in returns, somewhat more stable overall risk and return profiles. And I think you'll see that come through when we get into the results. So on the next page, overall, you can see that for the first quarter, the credit category, like most major asset categories, did experience some declines, but outperformed the custom benchmark quite nicely. You see a lot of the benefit coming through here in the 1 year period when the custom benchmark would have produced 0 returns. You still had 400 basis points of positive returns. So really, really strong outperformance for the credit category overall. And that played through in influencing the longer term results as well, where you have really strong results of 5.8% versus 4.2% for the overall category. So this really speaks to the overall implementation plan and the manager selection that you all have had within this portfolio. Next slide. So this is the liquid portion. We're only able to show it for the first quarter because this was a new category that came out of the strategic asset allocation. So there's no actual historic data for the category at this level other than the quarter. In future credit reviews, we'll be building out that historic track record and being able to report on that a little bit more robustly. But nice outperformance here in a category that was clearly challenged by the first quarter's overall environment. Next slide. I think this is going to be the star of the show, so I'll let our friends at Alborn talk a little bit more about that. But at a super high level, outperformance across all time periods, that the 1 year performance number is really strong. There's also some lag to these where there's a 1 month lag. So while the public market stuff may be looking at end of March, the actual results for these portfolios would be February. So likely to come down a little bit just based on what we saw from the other pieces of the market environment. but still really strong outperformance for all these categories in this review period. Next page. Overall high yield. So this is getting into subcomponents within the liquid category. So while you had negative performance in Q1, the portfolio and the manager selection was actually positive. So you outperformed there. Same story on the 1 year period. And then when you look at it over the 3 years, basically in line with the larger high yield universe. So really good recent performance. There's been a lot of work on optimizing this lineup over the course of the last couple of years. So staff's done a nice job of implementing along with the lines of the new strategic asset allocation and getting some pretty strong results here in the shorter run periods. Next page. Bank loans. So bank loans are floating rates, so they don't have the interest rate sensitivity that you experience in high yield and other areas of the fixed income markets. So these are more muted results, at least in the short run. The only major driving factor that influences these are credit spreads widening, and for the most part that happened in the second quarter and through the summer, and not as much into this March period. But longer term, you can see strong contribution serving its role in the portfolio quite nicely. And then also the implementation has been strong with some manager outperformance here across the 1 and the 3 year categories. Next slide. Emerging market debt. This is one area that seems particularly weak. Just to highlight where this fits within the overall portfolio, the weight here is quite small. It's less than 1% on the strategic asset allocation basis. Prior to the last strategic asset allocation, it was still also a relatively low weight, but it was 2%. So it's been cut in by more than half within the weight of the portfolio. And they have experienced consistently negative returns over the quarter and the 1 year period. That 1 year period heavily influenced by China, but now growing concerns for the rest of emerging economies on food and energy price inflation, possible risks of devaluation in the strong dollar environment, and a lot of challenges here, but it is a very low weight within the portfolio overall. Next page. I think that does it for our presentation. We do have a couple things in the appendix, but I'll turn it over to our friends from Alborn to drive the rest of the presentation home.
Madam Chair, members of the committee, good morning. Thanks for the opportunity to talk about the liquid credit portfolio. Most of my comments will be based around the next slide, which breaks the portfolio performance down effectively into 2 periods. The 2017 to 2019 period is really the legacy portfolio, and then each of the quarters since then. So the first part is annual, the second part is quarterly. So I wanted to draw attention to really what's happened in this portfolio over the last couple of years. So this portfolio is very much one that is in transition. The 3 significant allocations have been made since 2020 to 3 managers, as you know, Napier Park, Magnetar, and Silver Rock. I think the interesting thing to point out is the Napier Park allocation was made back at the beginning of 2020, just as COVID-19 was getting into full swing. That provided the manager with, I think, a very opportunistic backdrop to commit capital. And obviously that capital's continued to be committed. The capital to Magnetar got committed middle of 2020. So further adding effectively to the dry powder that the managers had in what was, again, quite a good credit backdrop. And then the final allocation was made right at the tail end of Q1 of this year, which puts new capital available for, again, looking ahead, which is going to be another sort of interesting period in which to invest. So I think good timing in terms of ramping up this portfolio. A couple of things I wanted just to draw attention to on this chart. Firstly, as you'll see, the performance of the direct and the illiquid credit portfolios are sort of basically narrowed between the 2 over the last few quarters, That's obviously as the fund of funds exposure has diminished, and it's now mainly a direct portfolio. But more importantly, and I think most sort of credibly here, is that in every quarter since the beginning of 2020, you've seen the direct portfolio outperforming the high yield index. I want to just dig a little bit more into that now. I think one thing to mention about the first quarter of this year, which is where the slide finishes, is whilst high yield did sell off, actually the sell-off wasn't particularly dramatic in the first quarter. That's because the market, as I think Tim was mentioning, was focusing a lot on inflation and the worries about inflation, and therefore interest rate expectations were going up. But the market wasn't really worrying about recession. So credit spreads remain relatively wide. Even in the liquid side of the portfolio, we weren't seeing much in the way of sort of anxiety, distress coming through yet. That changed in the second quarter. Obviously, can't see that, but in the second quarter, as we know, the markets became much more concerned about recession, and therefore you saw credit spreads widen out, and that's hit high yield since the second quarter. Another thing to mention with liquid credit is that price discovery is a little bit slower. These are assets which, say by definition, are traded less frequently. So that price discovery means that there is a little bit of a lag in terms of the pricing. So you do tend to get a little bit of a catch up over time. And that's one thing to sort of expect going forward. But I think going forward, also with the high yield environment at the moment, this is actually quite a good environment for some of the managers to be building out exposure. So these three managers make up the core of the LACERA sort of multi-credit commitment. I think over time there'll be opportunity to talk about more niche and more specialized managers. But for the moment, this is a very, very strong core of a portfolio. The next slide just sort of summarizes the main allocations as they are at the end of the first quarter. Obviously, the two managers that I've mentioned make up over half of the NAV of the portfolio at the moment. There's also some legacy commitments here, and as the committee will remember, I think PIMCO allocation was transferred from the hedge fund portfolio some time back. So there's again, it goes back to the fact that this is a portfolio in transition at the moment and continuing to be built out. The final slide I just wanted to show actually takes a look into the portfolio and looks at the regional exposure. We have Open Protocol, which is an open source method of looking at the underlying exposures within portfolios. And we have that data for three of the managers, PIMCO, Napier Park, and for Magnetar, which accounts for about 60% of the total portfolio now. And what you see on the top chart here is about a quarter or slightly less than a quarter of the portfolio is exposure to Europe and Asia. The rest is North America. So its portfolio is very dominated by North America at the moment, and perhaps that will be one thing that we'll keep on thinking about going forward. What's interesting, though, is actually on the net side, so taking the longs and the shorts, you actually see the portfolio is very much dominated by the US. So it sort of suggests that the managers actually, if anything, have a bit of have a short on net Europe to take some of that European exposure out. So that's just, I thought, was an interesting comment on the portfolio itself. I will pause my comments there and happy to stand for any questions.
There's nothing in the chat session. Does anybody have any comments or questions at this point? Yes, Ms. Jones.
Marty, thank you. I just had a few questions. And this was on the previous presentation, I'm sorry, when we were talking about how we lowered our target allocation for liquid credit and illiquid credit. And I was just curious to how close we are to those benchmarks that the 4% for liquid credit and the 7% for illiquid.
Who wants to handle that? Vache?
I'm looking at the weights right now, and I believe, well, first off, we're within our target ranges,
Right.
but
Right.
because it takes a while for illiquid credit managers to call capital and ramp up the portfolio, we're still underweight the 7% illiquid credit allocation. I
Okay.
believe we're about 8%, but let me check those numbers while we're doing the next agenda item, and I'll get back to you for
Okay.
the numbers as of 6:30.
Right, right. Thank you. Yes, I was just curious. And then the other question that I had, and this is just for my understanding, on the slides, we have our blended benchmarks on each of the presentations, liquid custom, credit custom benchmarks. Where are the benchmarks coming from? How are those benchmarks determined?
The benchmarks are the indices that are used to measure the performance of, for example, high yield. For high yield, it's a high yield index. For bank loans, it's a bank loan index, as you can see in Tim's presentation. Same thing with emerging market debt. So we take those benchmarks and we weight them. So the benchmark for liquid credit is 40% high yield, 40% bank loans, and 20% emerging market debt, where that emerging market debt allocation is itself a combination of 3 different emerging market debt indices. 10% sovereign debt, which is dollar denominated, 5% corporate debt, which is also dollar denominated, and 5% sovereign debt, but in local currency terms. Now, that's the liquid credit benchmark. For illiquid, we take that benchmark and we say we want to outperform that by 150 basis points to compensate for illiquidity.
Right. Gotcha. Understood. All righty. Thank
And
you.
the process, the board approves each of those benchmarks. So following the strategic asset allocation review, where the board approved the new asset allocation in May of last year, I believe at the July meeting, there was a presentation reviewing each one of the benchmarks, and then the board approves those benchmarks. Those are then incorporated into all the performance monitoring and then also into the IPS, which I think was presented at the August meeting for approval.
Awesome. Thank you
So
so
there's
much.
a robust process around how those are reviewed and evaluated and ultimately approved.
Right, right. All righty. Thank you. Those are all my questions.
Thank you very much. Anybody else?
Actually, Madam Chair,
Yes.
in response to Ms. Jones' question, my colleague Chad Timko sent me the numbers. So thank you, Chad. Let's see. The credit allocation overall is at 11.1%. Liquid represents 6.5%, and illiquid represents 4.6%. And I believe, are those numbers as of June 30? I believe so. So we're still below the target weights, but we're getting there.
Right. We're headed in the right direction.
That's
Gotcha.
right.
All righty. Thank you.
Thank you, Vache. Okay, does anybody else have any? Jonathan?
Good morning, Madam Chair. Tim, the information he added was what I was going to say.
Okay, thank you. All righty, Mr. Kennedy, are we, were you taking a pause in your presentation, or are we concluding it?
Well, Madam Chair, we're going to go on to the second agenda item, which is to perform the same sort of performance review now of the risk reduction and
Reduction and
mitigation
mitigation.
category.
Okay.
And
Vache.
so
Take it
again,
away.
similar to last time, Tim of Makita will cover liquid credit. And this time, Steve Kennedy of Allborn will address the performance of the hedge fund portfolio. So without further ado, I'll turn it back over to Tim.
Great, thank you, Vache. Thank you, Madam Chair and committee members. I think we can advance a couple of slides forward on this one, all the way through this. I think it would be to page 11. We've already reviewed the market environment, so I'm not going to go over that one twice. This slide helps paint an overall backdrop, goes over some of the shifts that were made at the last strategic asset allocation. I think these really highlight the importance of strategic asset allocation overall, because I think they're going to have meaningful impact on the portfolio returns that you see, not just for this quarter, but particularly once you look at the full fiscal year results a little bit later today. But the overall category target was reduced from 24 to 19%. The target to investment grade bonds was lowered from 19% to 7%. As we were going through that exercise, we discussed a lot of different things with staff and the board about the potential for a rising rate environment, but also just the fact that investment grade bonds were yielding such low levels that it was going to be challenging for them to be additive to the overall category's role of producing even moderate income. And they did have the risk of potentially having negative portfolio returns. And so that category was really heavily reduced. The long-term government bonds category was added. So that increased the overall, it's a new category. Some of that might have been included within investment grade bonds, but higher duration, a little bit more interest rate sensitivity, but definitely more of a defensive flavor to it. With the rising rate environment being the only dominant category in this performance period and really the first half of the year, long-term government bonds suffered, but recently you've seen with the yield curve inverting and concerns about recession that those have actually provided some positive results and some clear diversification benefit, which is the other role of this category overall. The other key piece here was increasing the allocation to hedge funds from 4 to 6%, based on sort of the overall risk return characteristics looking more attractive there. And then also, really, to be quite honest, LACERA has been really successful at implementation within this category. So moving to a place where you have a defined strength was an important consideration in the strategic asset allocation as well. So with that, I think we'll move into the actual results. So here you can see the category overall, like most asset categories, did suffer in the first quarter, but you outperformed the benchmark by 50 basis points. On the 1 year period, negative results, but somewhat more muted, and still some overall outperformance. And the longer term performance in this category has really served its role in the portfolio, which is moderate income and some diversification benefit. And you've produced 2.9% return there, outperforming the policy benchmark fairly handily by 80 basis points over the longer term period. Moving on to the subcategories. Within investment grade bonds, this has been the area that we shifted away from. So you can see sharply negative performance here in the first quarter. And as we mentioned, when you follow that through the end of the June quarter, one of the worst starts to fixed income, or the worst start of 6 months to fixed income for an investing calendar year. But the weight has been reduced here. The portfolio has generally performed in line with some modest outperformance over the 3-year period. A large piece of this is passively implemented because it's a fairly efficient piece of the market, and the roster has been consolidated really to one passive mandate and then 2 active managers that sit underneath the category heading. Next slide. long-term government bonds. So this is a new category. This is 100% passive implementation. So over time, this should track very tightly, but it's a new category. So all you're really looking at here is 1 quarter's worth of results. You can see the heightened interest rate sensitivity in the category for the 1 quarter, compared to investment grade bonds, which were down 6. These were down roughly 10. But as interest rates have reversed on the long end somewhat, you should see some benefit from that over the course of the last month and change. Next one. Going into hedge funds overall, this is where we talked about leaning into some of your strengths, and you can see it really very clearly here on the quarter basis, the 1-year basis, the 3-year basis in particular. Really strong outperformance versus the overall custom benchmark for this category. And this is an area that's growing within the portfolio, while the other categories, which we saw with negative results, are shrinking. So with that, the rest, I believe, is just our benchmarks and appendix stuff. So I will turn it over to the Alborn team to discuss hedge funds in more granularity.
Well, thank you, Tim. Good morning, Madam Chair and committee members. Thank you very much for having us. So in terms of the hedge fund review, just starting on the next slide, we'll just do a little bit of a recap of recent performance, because I think what this helps to highlight is in the 12 months ending March 2022, most hedge fund strategies were performing positively and contributing positively to hedge fund portfolios, save a few areas that were a bit more challenged, in particular some of the equity long short spaces, things that had a little bit more net credit or equity exposure. But what you'll see on the next slide is 2022 in the first quarter is a scenario where you've seen very strong performance in some of the strategies that are heavily favored and focused on in the defensive risk mitigating structure that this portfolio has been rebuilt to achieve. So some of the things that have performed a lot better in this market environment are macro-based strategies. Some of the managers that have been allocated in that space, as well as some of the relative value types of strategies that are more defensive in nature, rather than over towards the right-hand side of the page. You can see some of the strategies that have struggled a little bit more in the first quarter, and this slide actually continues through if you ran it to June as well. The second quarter was quite similar in terms of the return profile. Some of the things that have struggled, and you've probably seen it in the news, Wall Street Journal, et cetera, is equity long short has been very challenged in this market environment, as have some credit-based strategies that are more event-y in nature compared to the strategies that are very heavily focused on in this particular portfolio to be defensive and to have a profile that can have a positive return profile even when equity markets are selling off, as well as bond markets, which has been the story of 2022. So on the next slide, you can see the overall value added monthly index since inception. So obviously the portfolio was changed and allocated to some more defensive types of managers in the first and second quarter of 2020. So in that period, a few managers were added that were much more conservative in terms of their implementation and more relative value types of styles, as well as macro. And since that period of time, the return profile, and you'll see that in the coming pages, has further stabilized and been very defensive and beneficial to the overall plan. The distribution of returns over on the right-hand side helps to highlight that the positive skew. So the return patterns have generally been positive, and when they've been negative, save for the period of COVID, they've been quite modest in terms of any types of negative return profiles. And you'll see that in the coming pages as well. So it's been a nice distribution of returns, in particular since the additional implementations that occurred starting in April 2020 and the subsequent quarters overall as well, when the portfolio was more fully built out. Turning to the next slide. So here, this is representative of looking at, on this slide, the MSCI ACWI, and then on the next slide, bonds with the ag. What you can do and see from this representation is that when the markets are selling off, especially since in the last year and a half or so, the portfolio has generated positive returns in most of those instances. So the dark bars being the portfolio's actual returns, and the light green bars being the ACWI. And again, in 2022 in particular, you can see the portfolio has generally been positive with very, very slight negative returns in April and June, but overall positive on the year. And that's actually continued through July as well, even in a very challenging equity market environment. The next slide illustrates the same kind of phenomena, but in this case, we're mapping it against the Barclays Ag. So again, 2022 has been a very challenging market environment for 60/40, with both bonds and equities being negative. But this portfolio has been able to generate a fairly steady positive return in each of those environments. And even when the markets have sold off, the drawdowns have been very, very minor in overall performance. The next slide just is looking at the overall results against the benchmarks and objectives. So what we have here is the portfolio was originally set up to be US T-bills +5 as a return objective and benchmark until the portfolio was updated in terms of looking to have it more favor risk mitigating strategies. So again, lean into some of the relative value and macro strategies that can be much more defensive in nature. And then from that point onwards, it was changed to 2.5. So it's blended based on that point in time in the change. As you can see, across all trailing periods, the portfolio has outperformed that benchmark. In terms of volatility, the volatility has been quite modest. It's stayed within the parameters of 3 to 7%, save for the 12-month period where it's actually shot under on a volatility basis. And you can kind of see that from the prior slide where the returns were pretty steady and well behaved. Other periods, it's been running in that range, but nowhere near the top of that. Sharp ratios have been strong across all time periods, in particular the 12 and 24 months since the portfolio was really reconfigured. And lastly, in terms of beta to the ACWI, again, this is illustrative of the fact that on a 12-month and 24-month basis, so the current portfolio in essence, what was reconfigured, has really stayed well within the parameters of being under 0.2 to the ACWI, and on a longer term basis, it had a little bit more sensitivity, but in those earlier days, it had a little bit more equity types of strategies as well. So overall, I think the team's built an excellent portfolio to diversify the overall plan and provide defensive and risk mitigating characteristics to the overall plan. So with that, I will pause for any questions.
Thank you very much. Yes, Ms. Jones.
Good morning. Thank you for this. And I think I just missed what you said. I do see in the graph on page 24 that the performance has increased dramatically. And I know that it was what happened during that time. Did we get new managers and we reshaped the portfolio, or a little of both? I missed the significance of the shift in returns. We started outperforming the benchmark significantly.
Yeah, so the profile, so the staff had been working on the reconfiguration prior to March 2020. There was a lineup of managers that we had been working with staff to vet and determine overall weightings. Those allocations really started effectively April 1st of 2020, and then one in May of 2020, and a few others came on soon after that really favored and allocated to multi-strats that were relative value and very much more defensive in terms of how they tend to deploy capital, very conservative in terms of their implementation compared to some of those managers that are much more focused on equity long short trading, for instance, or credit based trading. Also, macro discretionary managers were being added to the portfolio at that time, and that's been a space that's been very beneficial to be able to trade around the big moves in rates and currencies in this market environment. So that's where the overall profile, and you can kind of see it becoming more skewed towards the upside, and the negative returns being much more muted.
Right. Thank you. Awesome.
Thank you. Is there anybody else? Yes, Jonathan.
Thank you, Madam Chair. I was just going to build on Steve's comments. Prior to the strategic asset allocation exercise in 2018, Ms. Jones, hedge funds were a standalone asset category. The objectives were a little riskier than they are now. The implementation was also different. We had several fund of funds providers where each had a portfolio of 20 plus hedge funds. So it was in some sense a higher cost portfolio, but also had higher equity exposure. When the board adopted in 2018 a functional framework, we folded hedge funds into the risk mitigation category. And part of the structure review that the board approved was going to a direct program to shrink the roster from 40 managers to a half dozen, 10 maybe. And so it's a much more direct intentional portfolio with the objectives that were in the guidelines that Steve showed in the presentation.
Thank you. That's very helpful.
Thank you, Mr. Prevail. All right. Seeing no further hands, are there any items for staff review?
No, Ms. Greenwood, we don't have any items.
Righty. Next is good of the order. Does anybody have any comment before our board meeting for good of the order? I don't see any hands. I will say good morning to you all, and I hope we have a glorious day. And with that, we have a little bit of time before we go to our board meeting. I would entertain a motion to adjourn.
So moved.
Thank you very much.